Financial modeling, topic 12, forward contracts and hedges, and simulated correlated random variables. Copyright Luganis. In this topic, we're going to compute no arbitrage forward prices for equities, currencies, and other commodities, compute forward payoffs, construct forward hedges using beta and correlation, and simulated correlated random variables. Let's start with what a forward contract is. But before we do that, let's talk about a spot or a cash transaction. In a spot or cash transaction, you buy an item and take a near immediate delivery. So if you go to, say, a grocery store and buy milk or bread and give them cash or credit, that's called a spot or cash transaction. All it means is you take delivery near immediately. Or if I go on E-Trade and buy a stock and take delivery that day, it's settlement, or buy a bond which settles in a couple days. Again, these are spot or cash transactions. If you enter into a contract to buy an item in the future, say delivery next week, next month, or next year, but you agree upon all the terms of the sale, you agree upon the price, the quantity, the quality, where and when it gets delivered, that would be a forward contract or forward transaction. Everything's been determined up front. Although there's been no cash payment up front, the only thing that needs to happen is a forward or a future date is the actual delivery and payment. So a forward contract is just a contract that discusses or lists the terms of the sale. This contract is signed by two parties, two counterparties, and we say that one party is the buyer of the asset, or the buyer, or it's called the buyer of the forward, or is also called the long party of the forward. That is the party that buys the asset. It's contractually obligated to take delivery and pay for the asset at the forward price. The other party is said to be the seller of the forward, or said to be short the forward. This is the person that's going to deliver the asset and receive the forward price. Forward contracts are just negotiated between counterparties in what's called the OTC, or over-the-counter market, which is just a network of institutions. However, some forward contracts are standardized and traded on exchanges, and if they are, we call them futures contracts. Examples of exchanges of forwards or futures are the Chicago Mercantile Exchange, the CME, or the New York Mercantile Exchange, the NYMEX. When you enter into a contract, if you're the buyer or the long position in the forward contract, that means you agree to take delivery of some quantity, Q, of the asset and pay the forward price. At the maturity of the contract, when the delivery is supposed to happen, there will be a certain spot price of the underlying asset. We say the payoff of a long party at maturity of the contract is ST minus F times Q. And the way we write that is because the long party is contractually obligated to pay the forward price. They can then take delivery of the item, the asset, pay the forward price, and then sell it into the spot market. And they make money if the spot market at maturity is greater than the price they agree to pay, F naught. Since this is a zero-sum game, the payoff for a short counterparty, or the seller of the asset, is F minus ST times Q. Because the short party must buy the asset in the spot market, assuming they don't own it already, deliver it to the long party, receive the forward price for the quantity of asset. So the short party makes money if the spot price gets cheap. They can buy it in the spot market and then sell it to the long party at a higher price. Let's talk about how to come up with a reasonable forward price in equilibrium for equities, commodities, and currencies. To do that, let's talk about something called a cash and carry arbitrage for a particular stock. Say you buy a stock in the cash market or the spot market and simultaneously enter into a forward contract to sell it. So say I buy a share of IBM for, say, $200 a share in the spot market and enter into a forward contract to sell the asset at a future date. In this case, I have no risk because I own the asset and have a contract to sell the asset. And furthermore, say you purchase the asset using a fully financed loan. So in other words, you buy one share of IBM for $200. You don't spend your own money. You borrow $200 at the bank, and then you enter into a forward contract to sell IBM in, say, a year. Let's think about the payoff for this contract. In this contract, you've bought the stock at S0, the initial spot price. You financed it at some rate R for, say, 1 year. So the S minus S times 1 plus R to the T is really the payoff of the loan. It's what you owe to pay the asset next year. And you have a contract to receive the forward price. So your payoff is the forward price minus the spot price plus interest. Now this position, which we call a cash and carry arbitrage, by the way, the name comes to the idea is you buy the asset in the cash or spot market today, carry the asset, and then also enter in a forward contract to sell the asset. So again, you buy the asset in the cash market, enter into a forward contract to sell it, and then carry the position for the maturity of the forward contract. This contract will break even if that forward price reflects the spot price plus interest, S times 1 plus R to the T. We call that 1 plus R the cost of carrying the position, which is only the financing charge. Now, if this stock were to have pays a dividend, we could have the dividend help offset the interest charge. So we say that the no arbitrage forward price that ensures no profit for this cash and carry arbitrage is the forward price, which is equal to the cost of carrying the position, which is the spot price times 1 plus R minus the dividend yield. So we call this R minus D for this R minus D, the cost of carrying for a dividend-paying stock. It's the cost to carry the position, the interest charge, minus the dividend that you received. So this is the no arbitrage forward price. This is the price which in equilibrium should hold to ensure there's no arbitrage. So I took a little example. On May 2nd, 2013, the spot market of the S&P 500 was selling for $1,597. At that time, the annualized dividend yield on the S&P 500 was 2.03%. And the 2-month, 5-month, and 11-month risk-free treasury rates are 4 basis points, 8 basis points, and 12 basis points. So I'm going to calculate the no arbitrage forward prices for 2, 5-month, and 11 months, or in years, 0.17 years, 0.42 years, and 0.92 years. Now the reason why I'm going to finance the positions at the risk-free rate or treasury is that by entering into a cash and carry arbitrage, you have a riskless position. So in theory, you should be able to finance the position at a risk-free interest rate. So I can then calculate my no arbitrage forward price for 2 months. It'll be the spot price times 1 plus the financing charge, 4 basis points, minus the dividend yield, 0.0203 or 2.3%, to the T power. So the 2-month forward price should be selling at $15.92. If I then compare the forward price to the spot price, I see that the forward price is selling at a discount to the spot. And this is always the case when the dividend yield is greater than the interest rate. In other words, my net cost of carrying the position is negative. I pay 4 basis points, but I've received 2.03 on the stock I'm carrying. Therefore, the cost of carrying the position is $15.92. It's going to sell at a discount. So that's an insight into financial markets. Forward prices have nothing to do with the optimism or pessimism of the underlying asset, in this case the stock market. It simply reflects the cost to carry. And even today, in 2015, spot prices are below forward prices. Forward prices are below spot prices because dividend yields are higher than short-term interest rates. If I repeated that for 5 months, spot price times 1 plus the interest rate minus the dividend yield to the T power, I get 1584. And then for 11 months, I get 1569. So you can see the forward prices are selling at significant discounts to the spot. And then I went to the Chicago Mercantile Exchange on that date and actually observed the forward prices or the futures prices in effect at this time. So instead of 1592, it's 39. The market forward price is 1592.50, so it seems to conform rather well to the no arbitrage forward price. 1585 was my no arbitrage 5-month forward. 1587 is the market forward price, and 1569 versus 1568. So it appears that the no arbitrage forward price does quite well in predicting what the forward prices actually are. Let's talk about cash and carry for more interesting commodities other than stocks. Let's say a live cow. Say you want to do a cash and carry on a live cow. Well, the forward price is just going to reflect the cost of carrying the position. In other words, buying a live cow today and holding it until the forward maturity date. So I'm still going to finance my position at interest rate R. However, with a live asset, such as a cow, you're still going to have to store it, or store the asset, or pay to have it stored, or pay to have it fed. So we're going to call S the storage cost, which is represented as a percentage of the spot price. So we're going to pay S to feed or house or store or pay someone to take care of the cow. So my cost of carrying the position includes the interest rate R and the storage cost S. However, if we have an asset, a real physical asset, we can generate cash off of it. So for a cow, we could lease the cow to a farmer. Or maybe we can sell off the milk. This L, this lease rate, is kind of like the dividend rate for a stock. It's any income you can generate from the asset. And then lastly, if there's any other conceivable benefit for having physical assets, we can call that the convenience yield. And that's the idea that while you're holding the asset, there's some other reason that you get benefit from holding it. We'll put that in the convenience yield. Now for gold forward prices, it'll conform to the same formula. Gold, we're going to finance the position at R, it'll be the same as cows. For gold, we generally say there's no storage cost because the gold can be held in certificate form. And would say on a typical user doesn't have any convenience yield for holding gold. But there is an active lease market for gold if you choose to use it. So the lease market for gold is actually derived from the market that short sell gold. So there are many market participants that at any given point in time believe that the gold prices will fall, and they look for people or investors that hold gold. They can borrow the gold, use that borrowed gold to sell it, and later hopefully buy it back at a cheaper price. So that short sell market for gold creates the lease market for holders of gold. So if you were to go Google lease rates for gold, I did last year, and I found that the current market price or yield was about 41 basis points to lease gold. At the time, the gold spot price was $12.65. So there's my spot. There's my lease rate. I'm going to assume I was looking at 1.8 year forward prices on gold, almost a 2-year gold forward price. The U.S. Treasury for 2-year deliveries was 37.5 basis points. So my no arbitrage forward price is $12.65 times 1 plus the U.S. interest rate for 1.8 years minus the annualized lease rate plus minus the convenience yield, which was 0, plus the storage cost, which we'll assume was 0, and I got $12.64. The last thing we'll talk about is a no arbitrage forward price is on currencies. A currency is just another asset. Say I could buy a euro today, finance it at R, so it will cost me nothing today. So my cost of carrying the euro so far are S naught times 1 plus R. However, I can take the euro that I just bought in the cash market, deposit it at a European bank, and buy risk-free bonds in Europe, say German bunds, that mature when my forward contract matures. So that asset I just paid S naught for, price of a euro, is used to buy a euro, which is then invested at 1 plus, or the European risk-free rate. So my net cost to holding a currency is the spot price of the currency times 1 plus the US interest rate divided by 1 plus the euro interest rate, or the foreign interest rate. Now that only works for direct quotes. Direct quotes are currencies are quoted in dollars, like dollar per euro, dollar per pound. However, most currencies are quoted in indirect terms, say yen per dollar or kroner per dollar. So if you want to do, say, yen per dollar, the forward price, the no arbitrage forward price, is the spot price, yen per dollar, times 1 plus the yen interest rate over 1 plus the dollar interest rate. So let me just check to see if this works on the Aussie dollar. On 2/14/2014, the Aussie dollar was selling for 89 cents in spot markets, and the 1 year forward was 85 cents, 84.74. Let's see if that conforms to the no arbitrage price. And this is actually the 2 year forward. I should make that 2 year forward. So what I can do is I can look and say that the 2 year US Treasury is 37 basis points. The 2 year Aussie is 2.82% annualized. The spot price was 89 cents. Therefore, the 2 year forward price is going to be the spot 89 times quantity 1 plus the US interest rate divided by 1 plus the Aussie interest rate, 282. And since this is a 2 year delivery, we'll take it to the second power. And you can see that the forward price, no arbitrage, is 85, which is very close to the actual market price. So now we talked about how to price forwards. We'll move on to using them to hedge. But let's summarize. Forward prices must conform to no arbitrage arguments. In other words, in equilibrium, the price should be one in which there's no arbitrage left in markets. And if we can do a cash and carry arbitrage, the forward price should be equal to the spot price times 1 plus, or the 1 plus the carrying cost. Any asset that can be relatively cheaply stored without spoilage can be priced using a no arbitrage argument. And any asset that can use that formula, we say is in the carry market. These assets include stocks, bonds, currencies, gold, silver, oil, and etc. Those are ones we can use our formula. And things like live cows and pigs and other commodities. However, some assets, such as electricity, are just too costly to store. Therefore, their forward prices are simply the expected supply and demand conditions at maturity. So let's talk about hedging with forwards. If you own an asset and want to guarantee a price to sell it, you can short or sell a forward contract to lock into the forward price. So the most obvious example would be ranchers that raise cattle. Ranchers that raise cattle could enter into a forward contract to sell cattle. Or miners that are mining gold could enter into a forward contract to sell the gold at a fixed price. Therefore, ranchers and miners can eliminate all their risks to prices and lock into a profit if they can lock into their cost to raising cattle and mining. Energy companies could enter into forward contracts to sell oil. Investors could enter into contracts to sell stocks that they own. On the other hand, some participants may determine they need to buy an asset in the future. For example, an airline determines it needs jet fuel in the future. It would use a long forward contract to buy the jet fuel. Or a restaurant, such as McDonald's, may enter into a long beef contract to buy beef in the future. What they actually could do is enter into a contract with the rancher. So the rancher and McDonald's could enter into a forward contract to exchange the beef for dollars at a later date. Another example would be, say, Hershey Foods. Hershey Foods is one of the largest consumers of cocoa or buyers of cocoa in the world. So Hershey Foods enters into forward contracts to buy cocoa. Let's talk about a simple hedging strategy. Say it is January and the New York Harbor heating oil number 2 is selling for about $1.80 per gallon for May delivery on the NYMEX, the New York Mercantile Exchange. Say there's a condo complex in New York and they've estimated they need 100,000 gallons of heating oil in May. They could enter into a forward contract to buy 100,000 gallons at $1.80 for May delivery on the NYMEX, and they've hedged their position. They're no longer exposed to increasing oil prices. Let's talk about a more interesting example. Suppose Southwest Airlines would like to hedge the cost of 100,000 gallons of jet fuel in May. Now, in this case, let's further suppose that the forward prices or the forward contracts for jet fuel are not developed enough to provide enough liquidity to make such a large purchase. In that case, Southwest will be unable to enter into a forward contract to buy the jet fuel required. However, Southwest could enter into a forward contract to buy oil, say heating oil, or gasoline to cross-hedge the cost of jet fuel. Now, a cross-hedge is a hedge using an asset that is correlated to the underlying position but not the underlying. In other words, as long as jet fuel and, say, oil prices move together, Southwest could enter into a contract to buy heating oil for May, even though it doesn't need it. But as long as heating oil and jet fuel move together, they can hedge their position. Specifically, if jet fuel prices and heating oil prices spike after Southwest enters into a forward contract to buy heating oil, Southwest will make a lot of money on their heating oil contract. Remember, the payoff is ST minus F. So if the spot price surges, they're going to make a big profit on heating oil. So they'll buy the heating oil at the forward price, sell it into the spot market at the higher price, and make a huge profit. And use those profits to offset the higher cost of jet fuel. So the trick is finding an asset that's correlated to the asset you're trying to hedge. So here's an example. Here's 5 years of monthly jet fuel, gas, and heating oil prices. So I'm going to take this data, I'm going to double click, make sure I get the full data. There's more than what's shown here. So I have 5 years of heating oil prices, RBOB, which is a particular blend of gasoline, and jet fuel prices. Now, heating oil and gasoline have developed forward markets, and that's why I chose those. So I'm going to calculate the returns of those 3 assets monthly. In other words, the percent changes in prices. So let me just take the May price minus the April price divided by the April price. So it's 8.5% appreciation. I'll copy that down. But let me delete off the last row, since there's always one less computation of returns than prices. And if I look at some of these prices, you'll see that heating oil, gas, and jet fuel are all up in the first month, all up in the second month, third month, they're all down, all up. Then you see some divergence. Heating oil's down, gasoline's down a little bit, jet fuel's down about the same as heating oil. Next month, jet fuel and heating oil are up about 11% and gasoline down. Next month, heating oil and jet fuel are both up to a little over 2%. and gas is down. So it appears from the data that heating oil moves closer to jet fuel than gasoline. But we can calculate that more precisely. I want to go to data, data analysis, correlation. I want to get the correlation of these three. Click on labels since I highlight the labels, and I'll put the correlation matrix right here. So what you see is the correlations between jet fuel and heating oil is 0.97. Jet fuel and gas is 0.78. So you want to hedge jet fuel using the highest correlated asset, heating oil. And then we're going to calculate one thing we're going to need for our hedge. We're going to calculate the beta between jet fuel and heating oil. And we'll just use our slope function. Slope. I'll put in my jet fuel prices, or returns, comma, and I'll put in heating oil. And what we see is jet fuel has a 1.03 beta to heating oil. So the 97% correlation matrix, or correlation coefficient, tells me that jet fuel and heating oil move together very strongly. You can explain 97% of the variation in jet fuel by looking at heating oil changes. But the specific magnitude of the relationship is on average when heating oil is up 1%, jet fuel is up 1.0367%. So jet fuel is a little more volatile. So let's talk about our hedge we're going to set up. So let's think about setting up a hedge in which I want to take a long position to buy heating oil. So again, I need to buy $100,000 eventually worth of jet fuel, and let's assume that the spot price of jet fuel is $1.50. So I need to buy, eventually, I'm planning on buying $150,000 in jet fuel. How Southwest hedges the position, assuming the beta is 1, we'll change it to 1.03 later, is my optimal hedge ratio is take the ratio of my $150,000 of the current value of my need in jet fuel, current spot price of jet fuel times the spot price, the quantity of jet fuel, divided by the spot price of my hedge asset. And let's assume our spot price of heating oil is $1.60. So if I take that ratio, I need to take a long position in 93,750 gallons of heating oil. Another way of thinking about it is 100,000 gallons of jet fuel is worth $150,000. 93,000 of heating oil is worth $150,000. So I just need to take a long position in the same value of the underlying. Now, assuming the beta is equal to 1, let me prove to you that this is a good hedge even though it's the wrong asset. So if the beta is 1, and say jet fuel and heating oil both go up by 20%, that's the definition of beta equals 1. Jet fuel is up 20%, and heating oil is up 20%. Let's see what happens to our bottom line at Southwest. The spot price of heating or jet fuel goes from $1.50, goes up 20% to $1.80. So Southwest thought they might pay $1.50 for heating oil, now pays $1.80. That's an extra 30 cents on 100,000 gallons. They're going to pay an extra $30,000 in jet fuel expense. However, they enter into a long contract to buy 93,000 gallons of heating oil. Heating oil is also up 20%. But they're long a forward at $1.60, which will, at this point, we'll just assume the spot price is equal to the forward price. We'll assume the cost of carry was 0 at that point. So they took a long position in the forward contract at $1.60. At maturity, the spot price of heating oil goes to $1.92, which is 20% higher. Their payoff of their forward is ST minus F times Q. They made $30,000, which perfectly offset the $30,000 extra expense in heating oil. So here's the big picture. Southwest wanted to hedge heating or jet fuel prices. Specifically, they're worried about the price jumping up. So they took a long position in a quantity of heating oil, knowing that they move 1 for 1. If they do move this 1 for 1, an increase in jet fuel prices will cause them to spend more for jet fuel. But that's offset from the profit they made in the heating oil contract. So in effect, they knew they had exposure to jet fuel. So in effect, they took a bet that paid them if both jet fuel and heating oil prices went up. Now let's look and see what happens if the beta is not 1, the beta is 1.03. The only thing I have to do is when calculating the number of contracts of heating oil, I just need to multiply times 1.03. So instead of getting 93,000 gallons, I'll get 97,000 gallons, because in this case, jet fuel is 3% more volatile than heating oil. So I'll need more contracts of heating oil. So if the beta is 1.03, if heating oil is up 20%, jet fuel is going to be up a little more than that, specifically 20.7%, which is 3.6% higher. So when we'll say heating oil does go up 20% and jet fuel goes up 20.7%. Let me show you how you're nearly perfectly hedged. Heating oil goes up 20.7% from $1.50 to $1.81. Jet fuel, or Southwest, pays an extra $31,000 in heating oil. But what you see is that expense of an extra $31,000 is perfectly offset by my forward contract that pays me $31,000. So your beta adjusts the optimal quantity to account for the higher volatility of jet fuel. So my optimal hedge ratio is going to be the beta between my asset and my hedge times the spot price of my underlying asset times quantity divided by the spot price of the underlying hedge asset. And the expected risk will be reduced by the correlation between the asset and the hedge. So in my last example, heating oil and jet fuel had a 97% correlation coefficient. So I'll eliminate 87 or 97% of my risk to jet fuel. So to establish a cross hedge, which is a hedging an asset with a different asset, in other words, hedging jet fuel with heating oil, and examples of those are, like we just did, an airline hedging jet fuel with crude oil or heating oil forwards. Another example of a cross hedge might be an American firm that has an exposure to changes in the Danish krone. Say the firm expects to receive or pay a large amount of crown in the future. Now this Danish crown or krone is pegged to the euro, so it's perfectly correlated to changes in the euro. So a firm that has an exposure to crown can hedge using a contract to buy or sell euro. And as long as they move 1 for 1, they'd be perfectly hedged. Another example of a cross hedge would be a firm like Hershey that wants to hedge cocoa prices, but the cocoa in the forward market is a little bit different than the cocoa they require. So an example is Hershey. Let's pretend they like cocoa that's produced in Ghana. However, the forward contract generally is delivery of Ivory Coast cocoa. Well, as long as Ivory Coast cocoa and Ghana cocoa move 1-for-1, highly correlated, then Hershey Foods can enter into a contract to buy Ivory Coast cocoa. If both the price of Ivory Coast cocoa and Ghana cocoa rise, Hershey's hedged because they'll take any gain from their long forward contract in Ivory Coast cocoa, use that to pay for the more expensive Ghana cocoa. Also, you can hedge, say, a single stock purchase by taking a position in an index forward or futures. So you can hedge, say, the price of IBM by entering into a contract to buy or sell the S&P 500, as long as they're highly correlated. So those are all examples of cross hedges. The steps to creating a risk minimizing cross hedge is to first find an asset that's highly correlated, that trades in the forward market. Once you do that, compute the beta between your asset and that high correlated asset and determine the optimal hedge quantity. And this picture shows the difference between correlation and beta. If these blue dots represent different points of return on, say, a particular asset, and the return on, say, the S&P 500, say the return on IBM versus the return on S&P 500, if these dots represent different points, so at this point, this is the return of the S&P 500, and this is the return of IBM. If they plot along a single straight line, we say that's perfectly correlated. If I knew that any return in the market, I can predict perfectly the return on IBM. The slope of that line is the beta. However, if those dots plotted along this best fit line like this, the beta still could be 1.4. That's the relationship. For every 1% change in the market, there's a 1.4% change in IBM. However, they don't perfectly plot along the line. So this is a case of the same beta as this picture, but a correlation less than 1. So let's just take a look at this example with IBM. Say you own 1,000 shares of IBM, currently selling for $199. So you have $199,000 worth of IBM. You want to hedge your position over the next year and lock into a price to sell IBM. However, the single stock futures aren't available for IBM. What you can do is you can set up a cross hedge. Say there's NASDAQ and S&P 500 futures contracts or forward contracts. If IBM is highly correlated to either the NASDAQ or S&P 500, I could hedge my sale of IBM by entering into a contract to sell the NASDAQ or S&P. So I went and calculated some historical data for IBM, NASDAQ, and the S&P. There are the returns. I calculated the correlations between IBM and itself, IBM and the NASDAQ, and IBM and the S&P 500. And what you see is it's correlated most to the S&P 500. So I'm going to hedge my IBM exposure by entering into a forward contract to sell the S&P 500. So I do the following calculations. I compute the beta between the returns of IBM and the returns of the S&P 500. That beta is 1.084 or 1.184. And then I calculate my optimal hedge ratio or hedge quantity. That optimal hedge quantity is going to be my beta 1.184 times my spot price of IBM. That's actually 199.63 times my 1,000 shares. divided by the spot price of the S&P 500, 1582.70. So it's my optimal hedge ratio, H, is equal to beta times the spot price of IBM times the quantity of IBM over the spot price of my hedge asset. That turns out to be 149 contracts. So I hedge my exposure to IBM by entering into a contract to sell 149 S&P 500 portfolios. I'll reduce my risk to IBM's price changes by 78%, the correlation. Last thing I want to do is an unrelated topic, and that's simulating correlated variables. All the simulations we've done in the class so far, I've always assumed that the variables that I simulated and generate random variables for were uncorrelated. So all the examples we did before were looking at periodic returns of a portfolio. And I always assumed that period 2 was independent from period 3, and period 4 was independent from period 3, and so on. So let's look at this example. Let's grab this data. Copy that. I want to make sure I get out of PowerPoint. And I'll paste it. And make sure you have at-risk running. So in this case, I have a portfolio of IBM, Apple, and Google. I'm 1/3 invested in each asset. Expected returns were given. Here's my standard deviations of each asset. And I calculate the covariance matrix, which is the vols times the transpose of the vols times the correlation matrix. I'm then going to estimate my random walk simulation for each asset equals the mean plus the risk normal 0, 1. That's my random variable z times the standard deviation. So there's my random variable for IBM, Apple, and Goog. Mean simulated returns, just mean plus risk normal 0, 1 times standard deviation. And let me replace this bottom formula to just be the sum product. I'll take my weights, comma, my returns, and there's my simulated portfolio value. I'll add that as an output in at risk. I'm going to close PowerPoint for now. And now if I were to run the simulation on 10,000 iterations, what you'll see is you'll get a mean of 9.5. Although look at the standard deviation of 14.9. So the standard deviation of that portfolio is 14.9. So let me write that in here. Mean of 9.5 and standard deviation of 14.9. Now notice that's different than the standard deviation we expect. Because given the correlation matrix, which then determined my covariance matrix, I determined that the volatility of that portfolio is my M-volt transpose WSW times 1/2 power, 22.8%. So with 14.9, let me show you what that represents. If I were to make all these correlations 0, except for the major diagonal, everything's 1 with itself. Notice how the correlation or the standard deviation goes to 14.9, which is what my variable showed. So if you don't specify correlations in at risk, it assumes 0 correlations, and that's why we got 14.9. To generate correlated random numbers in at risk, we have to put this correlation in at risk. Now if you go with the steps in the PowerPoint, that's what I'm going to do right now. I'm going to go to my at risk window, click on model window. I now have one output, three inputs. I'm going to select my three inputs by holding the shift and clicking all three. I'm going to then do a right click, correlate, create new matrix. This is my blank, empty correlation matrix. I then need to make sure it looks like this correlation matrix. This one's alphabetical, so I need IBM, Apple, and Goog. It has Apple, Goog, and IBM. So I'm going to grab IBM's column and move it over here. So now it's IBM, Apple, Goog, just like this one, IBM, Apple, Goog. I'm going to right click again, copy coefficients, click on the actual correlation matrix, not the covariance matrix, and hit OK. Now these two are the same, this one and this one. Now for at risk to use it, I need to make it a location. So I'm going to click on that, and I'll just paste it down here. And hit OK. And hit OK. And hit OK. This is the actual correlation matrix at risk is going to use. You can see it looks just like the one up here. Now, when I run at risk, well, first of all, we go back to a model window. And what you'll see is what you just created. We added several correlation terms. Now, when I run my simulation, click back here, what you're going to see is you're going to get a 9.5% mean and a 22.9 standard deviation. And there it is. So my correlated results are 9.5 and 22.9. Let's talk about for a minute just how this is done in at risk. Before I put in the correlation matrix, at risk generated a random variable for Z. Oh, by the way, you can see here's the formula that at risk added the correlation term in there. But what it would do is it would generate a random variable for Z in this first cell for IBM, which gave me a random return, and then a random for the second, then a random for third, calculated the total return, and did that 10,000 times. That's assuming they're uncorrelated. Once I put the correlation matrix, now here's what happens. It generates a random Z for IBM. And say that random Z is 3.0, which is a really high random standard normal variable. Once it generates a high Z for IBM, it's going to generate a random variable for Apple, but it knows that IBM and Apple are correlated. So it's going to be more likely to generate a higher one for Apple. It's not going to be independent. And then when it does Google, it's going to see what the random variables were for IBM and Apple, and then also generate one that's more likely to be high since the correlations are high. So that's the difference between generating 3 independent variables and 3 correlated variables. Then it'll just do it 5,000 times. So in this topic, we looked at what forward contracts are versus spot and cash. We calculated how to come up with no arbitrage forward prices using a no arbitrage argument with the Cashandcarry arb. The Cashandcarry arb forward contract price says that the forward price is the spot price times 1 plus the cost of carry. We then looked at the payoffs of a forward contract. For long, it's ST minus F times Q. Short, Q minus ST times F. We then established hedges. I could hedge a sale of an asset by short forward. I can hedge a purchase of asset of a long forward. I then did cross hedges. Find an asset that's correlated with my asset and use that contract to buy or sell in the forward market. And then we generated correlated randoms.